Buy the dip, some have said. Looking at what is going on in the economy itself, it's a very different story. What would happen if the Federal Reserve hiked interest rates going into a recession? That's the big question today. The first thing I want to look at is spending. No spending. I'm going to show you the data surrounding what's happening with the consumer. The second is where to invest. Where's the big money going? I'm going to show you that. The third thing is the market volatility. Up and down and sideways all over the place. I'm going to give you the details. And if you stay until the end, I'm going to show you why your jeans and t-shirt are about to get a lot more expensive. Let's begin. Let's start right here. We estimate household income dipped below 2020 trend after the expanded child tax credit expired in January. This is the data coming from Goldman Sachs, who really tabulated this from what they got from the Department of Commerce. And this is important because if you look at what has happened with all of the different stimulus packages, every single time we see a spike, and that occurs exactly when there's some sort of stimulus package. Remember, this has nothing to do with quantitative easing in the Federal Reserve. I'm talking about what happens with the government. They inject capital, or they inject cash right into people's bank accounts. And as a result, guess what? There is stimulus effect. That's the whole point of it. I understand that. And of course, I know you do as well, but we can see that and actually look at it on the charts. Here is one of those. So you've got the last little bit of that, and this is the expanded child tax credit. It's expired January, and now of course we see the potential for a recession taking hold, because an economy trying to rely on a consumer that quite frankly cannot spend is a problem. You've got some people who are making more money than ever before, and we watch that with the luxury brands doing better than ever. Rolls-Royce and Bentley and so on are selling more than they can produce. But at the other end of the spectrum, you are seeing people who can't afford to eat, and this is more than ever. More than ever. It's not as if, look, we have always seen a disparity in between the rich and the poor. That has never changed. But what has changed is the fact that there is a growing group of people who are considered to be middle class who can't afford the basics. Something's going on. The pullback in sensitive services likely caused an outright decline in overall services spending in January. This is affecting everybody, the services, and of course, what we look at with manufacturing, the manufacturing isn't taking place. We'll look at that. That is really the key for today. And you could see that going on. Of course, at the same time, you've got restrictions, you've got lockdowns, you've got all these different things depending on which city and which state and which province and so on. But it's going on all over the place. This happens to be US data. Again, Department of Commerce pulling that up. Now, the Federal Reserve being key to what's happening, I think everybody should pay attention to all little bits and pieces. The Federal Reserve's bargain says that businesses would welcome higher interest rates. I'm not so sure. Depends on which business. Of course, I think the banks would love it. They'd like us to get back to at least a normal interest rate posture and not be simulating more demand on top of normal levels. You see, because when they do this, they know what's going on. Businesses know what's going on. This isn't real. This is fiction. And of course, this comes at a time in which trillions of dollars have been pumped out there and they don't know how to turn this ship around. One of the things that has become extremely expensive, as you know, is energy. And if you look towards Europe, my friends in Europe, hit that thumbs up button. I try to collect as much information as I can for you, so definitely hit it down below. How Europeans get their electricity. If you look at this chart here, it gives you the legend at the bottom, and we can look at different places. For instance, France is nuclear, okay? Primarily running off of nuclear energy. Poland, on the other hand, is coal. And I just wanted to show you that because you look at the fluctuations in the price, you see what has happened here, but it's going to affect every region differently. So this gives you a little bit of insight into what's happened. Look, Italy, natural gas. Some places like Austria are able to run off of hydro primarily. So you look at that, and I really think it helps people understand that if the oil prices are going high, that's going to affect different areas more than others. Speaking of oil price, looking at this, I mean, my goodness. By the way, the spread in between the WTI and the Brent is really, really shrinking. You look at a WTI at around $88 and the Brent around $89. So this is clearly, very clearly, heading higher over the last little while, and that is going to be a burden for people. People are unable to pay their bills already, and then you add on top of that, when oil prices go up, transport goes up, as well as what's happening with the transport all over the place. A lot of the truck drivers are saying, we're not going to be doing business this time around, so we'll see what happens with that as well. This is the big one. If you stay this far in, we're about 7 minutes into the video. This is key. Watch this. It's, by the way, from Morgan Stanley. It's fire and ice, with slowing growth now the biggest issue rather than higher rates. Look at it. Manufacturing PMI year-over-year change, something I cover all the time. And this is showing us what has happened here. The indicator is essentially highlighting the fact that we could be at a PMI of 48 to 54 by March-April timeframe. What does that mean? Anything below 50 is going to be a contraction. Okay, pardon the crude drawings with my trackpad here. 50 and below, contraction. So we are going to be there very soon. And you can see very clearly, this is 2012 up until the present, the correlation in between the PMI and the stock market is apparent. I'm going to talk about the stock market in just a second. It's going to lead us into the next part. But what's happening here is essentially trying to highlight these two, the connection point in between the two, and where we could be in the coming months. Now, on top of all of that, you are looking at a time in which we've got trillions have already been pumped out there, all kinds of stimulus. And think about a tightening at this time. Oh my goodness. This is just talking about Monday's trading session and where things have been, and the VIX index, and of course the Federal Reserve and all of these things. Okay, I just wanted to show that just to lead in to these statistics. This is coming from the beginning of the year up until now, looking at growth versus value. Now, while we have had a big sell-off coming in more recent time, looking at what is going on, I mean, clearly growth has sold off and value has picked up. Now, that could be changing over the last couple trading sessions. That has kind of come together, that chasm has closed somewhat, but we are still way off. Okay, if I show you what's going on in the charts themselves, this is the dollar index, but I wanted to show you this. You can look at, this is the QQQ, that's the NASDAQ essentially, coming off the bottom. We are coming up. Now that was expected because of the rebalancing. I believe I talked about that on yesterday's video. The rebalancing that happens, there's always these purchases that occur from the institutional side at the end of the month. So that usually does result in a lot of buying that happens. So we'll see if that is sustained. This is the Dow Jones, and you could see there if the individual investment companies and so on are looking for different names. They're not looking for those high flyer tech stocks. Well, in different scenario. Look at this. Defensive leadership continues. Defensives, that's the blue line, as at the beginning of the year, clearly outperforming the other sectors, value just under that. But then you look at secular growth, punished throughout the period, okay? This is just showing you that there have been more puts. Puts is basically a bet, an option that the stock market or a particular stock will go down in price. And that has been picking up over the years in total. But of course, there's just more of everything today. But at the same time, you've seen more just recently, more bets that the markets will come down. And you look at it broken down, single stock as well as indexes, and essentially just trying to highlight the fact that people are betting broadly that the markets will fall. That's all I'm trying to show you here. And again, broken down by volume, a lot more volume there. Okay, I don't want to just go into the depths of that, but you get the point. Now, looking at this right here, some have said this is the time to get into the ARK, Cathie Wood's ARK, unprofitable tech stocks, as they say here, momentum, SPACs, and Bitcoin, and so on. But there's another potential that, this could be a fake out. There have been other instances where this has happened before, and then it continues to retreat. So I ask you, is this a bounce, or is this simply a little bit of, a fake out? What do you think? How would you describe that? Looking at ARK and what has happened over the last while, since the beginning of the year, I should say, that it has been absolutely beaten down. Some are saying now is the time to buy the dip. Well, I can show you one thing here that I want to wrap this up with. Actually, I have to show you what's happening with your t-shirts and jeans. Stay with me. The global, basically what we're looking at here is the financial conditions. And this is the tightness that's happening right now. If I pull up the highlighter, looking at this right now, okay, this is March 2020, okay? And while 2021 bottomed out and we are starting to see this tightening that's happening, I don't like that word tightening. I struggle to use it because the conditions are real loose. But anyway, compared to what we had before, this is starting to come up. And that, of course, means generally weakness in equities. The equities don't like that. But there are always going to be some that can benefit from it. There are always going to be some that do well under tighter conditions, but broadly speaking. Now, you waited until the end, so I want to talk about your t-shirt and jeans. Cotton hits a fresh decade high, fueled by mill short covering. That's right. It doesn't matter who you want to blame. It's the inventory, it's the speculators, but all that matters is you. If you're buying hoodies, well then, it might be a little bit more expensive, okay? That's all. I think it's important to see how all of this affects you, the person, the individual, you, your family. You need to get real with that. And that's what I talk about all the time, to prepare. If you've got a 401k and it's being managed by someone else, you got an RRSP, you got a super, these things here, and you simply give it to somebody else to manage, I don't want to give financial advice, but I think we need to take control of this. I think we need to take hold of it, and we need to actually engage as much as we possibly can. Take hold of what you can, manage it, self-manage it, and look at all this data that I'm showing you and try to make the best decisions possible. If you appreciate the information, smash that like button. Is right down there, down below. I want to thank you for that. If you haven't seen this video yet, you got to check it out. Real good stuff in here. Click it and I'll see you there.